Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here's your weekly technical analysis of Kansas City and Minneapolis wheat markets. I'll start with Kansas City wheat. The low water mark of the 18th of August was pivotal to the construction of what happened next. Back then, the market fell to break down through the neckline, currently at 823, and highlighted in red on my daily chart, of the small but influential October 2021 to January 2022 head and shoulders top. The market chose instead to construct a new pattern, a bull channel, currently 1072 to 1128. This was easy enough to do once prices overcame the short medium moving average, currently at 948. Remember, this moving average will pop up later again. There was a small freeze zone above at the time, all the way up to the July 2012 high at 957. However, when the market reached 957, I thought there might be issues. You see, 957 is the gateway to a congestion area above between 957 and 1001, within which has risen and is now clear of the slowly rising long moving average, currently 1006. Additionally, a lot of this congestion was made up from 2011 and 2012 and was easily breached on the way up in February and on the way down in June. However, back in those days, the congestion did not have the additional reinforcement of the long moving average in its midst, and it is this, along with the upper bull channel line, you can see them highlighted in blue, that constrained the market early in October. In the process, the market took on a new shape, primarily caused by the weekly key reversal down made that same week. In fact, it's hard to judge if the shape made the weekly key reversal down or vice versa. Anyway, at the end of that week, the market broke down through the lower bull channel line, plus it dropped out of the overhead resistance area and even started moving below the now flatlining medium moving average for a while, currently at 914. Then along came the very early November action, or as I refer to it, a week of time wasting, but also a week of defining his industry. This is a parallel of what we saw in Chicago wheat futures. I will expand on that shortly. But first, I would like to look at part of my commentary from last week that is still seemingly valid, and I quote, "Much like Chicago wheat, though it is not a complete duplication, this market has two avenues, though there will no doubt be more available. Eventually, the first is the straightforward move down with the potential targets for the break of the bull channel. Thus, we have a primary target X down in the 903 zone, whilst the secondary harder to reach target X1 is way down below in the 759 zone. This leads to the second avenue, is the possibility for the whole of the July today action being not just a flat bottom, but a flat bottom with an extension. Extensions have something like a bull flag within them, and that is what may just be being built here ever since mid-August. Personally, it looks a little slack to me as a pattern, and it is an untested But if the short medium moving average, currently at 948, manages to hold the market up, and I will add this week the target X at 903 to that list, if it even manages to hold up the market and we then see prices revert back up, well, then this second scenario, the larger bottom with an extension, suddenly looks a lot more interesting, and that's the end of the quote. I finally come to last and this week's actions. We have seen the market start to pressure the downside, specifically the medium moving average below, currently at 914. But, and is an important but again, but it is not going that well. Yes, we've seen the market approach and test the medium moving average, but not really breach it. At the same time, the combined resistance band overhead between 958 and 1014 has capped the market. It is a short hop down to target X in the 903 zone, but the market's finding it hard to get there. Now, I asked you last time to just consider the possibility that the action since June is a possible flat bottom pattern with an extension. In this case, more a slack bullish halfway hesitation extension rather than a bull flag inside the extension. This idea has not wholly expired, purely because prices have found it very, very hard to properly move and close below the 920 level. Perhaps, just perhaps, by not going lower, this market is eroding the bearish incentive with its sideways channeling. We have not learnt now for a third consecutive week whether the summertime flat bottom with an extension is a true idea. It still looks like it might, but nothing this week has helped nor hindered that idea again. I'm wondering if this coming week will provide any clues. Minneapolis wheat. Over July and August, we'd seen a slightly boring well, boring compared to earlier in summer, sideways to lower channeling market. In early September, there was the start of another bullish pattern. It seems to have been prompted by the approach at a steep angle from above of the short-medium moving average, currently 961. And rather than this moving average acting as a cap on any rise, it instead acted as a trigger for a move higher. Remember this moving average, it will come up or show up again later. This move higher seems to have been slower than in any other grains, which is a nice segue into the bull channel come ascending expanding wedge pattern formed over early October, and the one I've highlighted in blue on my daily chart. I'd previously called this construction rudimentary, not only because it was then rudimentary, but also because this market is, as I've often said before, was way behind both Chicago and Kansas City in its construction. You only need to look back at the flatlining long moving average currently at 1037 and the slowly declining medium moving average currently 940 to see this. Incidentally, this medium moving average currently 940 seems to have triggered the limited move lower seen in early October. Just look at the relative position of these moving averages compared to the same moving averages in any other grains market to appreciate how inferior the actions have been. Anyway, as I said earlier in early October, the market broke down through the lower trend line of the bull channel come ascending wedge pattern. This now leaves us with the same two avenues that I can see here as well as in Chicago and Kansas City, though there will, I'm sure, eventually be more scenarios available. The first is a straightforward move down with potential targets for the break below the bull channel come ascending expanding wedge pattern. Thus we have a primary target X on the downside quite a way lower compared to the other grain markets in the 883 zone, whilst the secondary hardest to reach target X1 is down in the 840 zone. This leads to the second avenue. It is a possibility for the whole of the July to date action to be a sort of rounded bottom, but a rounded bottom with an extension. Though to be honest, this one is really looking like it doesn't have such an extension in it. However, as I said 2 weeks ago, and I quote, "Here is the key. If the previously mentioned short-medium moving average acted as support as recently as yesterday, or even the 50% Fibonacci line of the August 2020 to May 2022 move at 955, if they manage to hold the market up, then we may, just may, see the opportunity for prices to revert back up. Then the second scenario, the larger rounded bottom with an extension, suddenly looks a lot more interesting." End of quote. Recently, I had been the first to admit that the current situation sees the market on the borderline of not happening at all. But I've previously felt obliged, and continue to do so now, to still mention it as a scenario, as the door has not been completely shut on this pattern idea. Last week, I thought there was a mighty tiny gap of light that was still showing. This week, because we really haven't gone anywhere, and arguably have tried higher, this chink of light is slightly bigger. All we have seen here last week, much as all we have seen here since October, and much as in Chicago and Minneapolis week, all that we've seen is a verification of support at the 50% Fibonacci line at 955 and the short medium moving average. This is the moving average that I had previously mentioned. Last week I had suspicion that this week may be crucial in defining whether the market follows onto the bull channel stroke expanding wedge pattern, or it somehow rescues the idea of a bullish halfway hesitation. This has not turned out to be that crucial, so I'm hoping this coming week may be the crucial week. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.